So looking at the topic today, I think one of the most fascinating challenges in the world of startups is spotting the next rare gem, what we call the next unicorn, um, especially when it's in its early stages. And I think the panelists will agree with me when I say the truth is it's far from obvious, even to the most seasoned investors, right? So if I look at an anecdote, I would compare it to spotting the winner of a marathon at the starting of a finish line. I mean, at the starting line, right? Some of the runners look like clear winners, like decked in the best gear, all the confidence in the world. And then there are others quietly warming up in the background, so unassumingly, right? But it's not really about that initial sprint. It's about a lot of factors, the strategy, the endurance, the ability to adjust to the terrain, and the ability to like just stay on top of things. So, sorry. Yeah, so with me, yeah, so sorry. Similarly, evaluating early stage startups isn't about finding that perfect idea or team right away. It's about recognizing a combination of potential, timing, market dynamics, the ability to adapt and stay on top of these factors as they evolve. Because what may look promising at the first kilometer may not be the case in the 50th, right? And today's discussion, identifying the future unicorn to invest in major areas early stage investors look into, is relevant for both investors and startups in the audience. For investors, this is a valuable discussion as it provides four distinct perspectives on how to evaluate startups effectively. And for startups, it's a chance to gain insight into what investors really look into and a chance to better position yourself for success. So we've already introduced this esteemed panel. So I'm going to start with the questions. Archana, I'll start with you. With a portfolio of over 50 startups across diverse sectors, how has your experience shaped the way you evaluate early stage companies? Are there any guiding principles you consistently rely on?
Yeah. So thank you so much, Tina, for asking this question. So I have invested more than 200 companies as an angel syndicate lead and also through the fund. Couple of my companies are also unicorns and sunicorns as well. But out of 200, most of them are none of that. So, um, but before talking about how to even identify a potential unicorn, I would like to give you a little bit of antithesis of that. That hunting a unicorn is also depends on luck, which you will never hear. People will always say I found that company and it happened, it became a unicorn, so on and so forth. But who is that investor who really picks up a bad bet? But not all of them becomes unicorns, only few of them, or if they are lucky enough. Second thing is, in the startup, you will have to be very humble about the outcome. Because, as she was saying, that the first stage, first kilometer, it looks very promising, and suddenly the rain happens and he slips or some, any kind of thing can happen. And then even if he's promising, but he cannot complete the 42nd kilometer, which is the final of the marathon. So you have to be very humble about picking up the unicorns. I mean, when you invest into the startups, about the outcome. Now talking about my playbook on which I work on. One thing is that I always look for, if I'm hunting for unicorns, Then the first and foremost thing is I will look for is the category creator, right? Whether that particular idea has the potential of creating the category in that space. Um, one of my picks, like Bank Open, it's a neo banking. There was none of the neobanks was existing at that point of time, and they had an excellent model team, and I picked that up. Then there are multiple other companies also in my portfolio, like Grow, Loham, Pilgrim. They are doing extremely good, and there are many more. So one thing is category creation, that and scalable category creation. That is one thing. The second thing is, since category creation is a tough job to do, you have to ensure that the founder has ability to raise the funds on a continuous basis. If he hasn't, then it's very hard to create category. Apart from that, you have to also look at the market readiness, that for that idea, how much the groundwork is already done on which it can piggyback. Like, you know, if you take a look at the Urban company, which is a very successful company in these days, if there was no Ola, or like, you know, cab aggregator and payment solution, that company would not have been so successful in many areas. Like, you know, beauty home services, massage therapy, and so on and so forth, which is their key category. So you have to also see if that category is getting built. Is there the things which requires to support that? Is it existing in the market? And other than that, leave it to luck, as I said earlier.
Thank you. Sherif, your work spans scaling global ventures and making socially responsible investments, especially in healthcare and AI. How does your investment thesis reflect your passion for impact-driven startups? What do you prioritize when evaluating long-term potential?
So first of all, I don't think there is a conflict there, right? Impact is a value that we bring to the table, and we don't like to look at things which are creating socially destructive things, which are, you know, impacting a lot of people negatively. But as long as there is some positive impact, we don't invest just on the basis of impact. Okay, our investment thesis is very straightforward. Our investment thesis is that there is a burgeoning, you know, middle class in India, which is exposed now to global standards in many things, in terms of convenience, in terms of quality, in terms of, you know, whether it be in healthcare, whether it be in home servicing, massage, or whatever. So there are certain qualities which, you know, there are certain things that people have got exposed because they have traveled to the US, to Europe, to even Middle East, and they want similar features when they come back to India. So companies which are solving for that, and maybe in the process of doing that, even creating something even better than what exists there. I mean, those are bound to be almost sure winners. So that's one thing that we look at. I'll take an example of a company which is not in our portfolio, but if you look at the quick commerce, this thing, I mean, people got, you know, accustomed to fast delivery because of Amazon and other things. These people have taken it one step further and said, in 10 minutes, we will deliver whatever you want to your home, which is not available in the Western market or which is not available this thing. So they've created a new category, like you know, what she was saying. And like Archana pointed out, the people who create categories are, again, you know, the probability of their success is much higher. If you look at the portfolios that we have invested in, we have invested in healthcare, where they've come up with new ideas, new products, which are not available anywhere in the world. And so, you know, that's a bet that we take. We have invested in a company in the food space. So I'm taking two extreme examples. So the healthcare was highly research-oriented. A lot of you know, intellectual power went into that in terms of technical these things, AI, and a lot of you know, IoT and other things went into that. Whereas we have another company which is doing much better than the first one, which is just taking kitchens and converting them to cloud kitchens. So it is taking the spare capacity of restaurants, and there is a data which says that 80% of restaurants typically close within the first year. So she goes and identifies those restaurants, find out how much of, what kind of equipment they have, what spare capacity they have, and then goes ahead and, lists her products. So she has created a brand of about 8 products. She gives the recipe, the raw materials to those kitchens and say, you make it. And I'll get you the order from Swiggy and Zomato. And, that company is growing at 6x per year. Okay, and we believe that will be one of the unicorns in our portfolio. So, you have different these things. So how we identify these things, I don't want to get into that. That's a long conversation which we will get to later.
Rajeev, you next. Having been a founder yourself and leading transformative initiatives like Reliance Jio, how has your experience shaped the way you evaluate startups, particularly in their early stages? Are there lessons from your entrepreneurial journey that come forward here?
Absolutely. Thank you so much, first of all. I look forward to this conversation. Good to be in Kerala, such a vibrant audience. I didn't expect the event to be so powerful and packed. Really nice. Well done. As they say in venture capital, we not only dream big, but we also invest in them and then hope and pray that there is traction. So that's essentially what it comes down to. Well, Kerala is God's own country, and there's something special about this place. Even coconut trees have got better ROI here than they have in other parts of the country, as it were. So I'm looking forward to the stuff that we are looking at. So I'm with BlueGreen Ventures. So what we are trying to do here, really, in terms of identifying a unicorn. First point about the unicorn is it's a mythical creature. It doesn't exist. वो हैरी पॉटर के बुक से every book will tell you that it's a mythical creature, it doesn't exist, वो याद रखिएगा, right? So if that's true, then the question is, what is a successful startup that you're looking at? Because ultimately it comes down to making a business work. There are lots of things that you can do, but in essence it comes down to 3 things that we look at. It's called the 3 T's: team, time, traction, right? So what is team? Team is really folks that make it up. That's maybe 60-70% of the thinking, right? So it's not just enough for you to be firebrand, energetic, enthusiastic, knows the business and all that jazz. It also has to be a full jigsaw puzzle of a team. You should have people around you that are able to sort of, make up for the lacunae you have, because none of us is perfect. Right? So that's one. The second thing is the TAM, that's a total addressable market. You need to have a large enough market. So this is very important for venture capital. So remember that every funding requirement is not a venture capital funding requirement. In fact, as a venture capital investor, I would say we are the last funders that you should actually come to, because our expectation of return is 50%. हमें 50% चाहिए, नहीं तो हम invest ही नहीं करेंगे, right? You would rather go to a bank which will give you a loan at 15%, right? So that's the second category that I would say is important. So the size of the market has to be large enough that you can show those kinds of returns. And the last one really is traction, which I started to talk about, which is essentially that you need to make dhanda happen, right? And if business doesn't happen, then behold, you're not going anywhere. So those are the 3 things that I would say, define this mythical creature called the unicorn that you will only read in Harry Potter. Thank you.
Krishnan, your expertise spans financial markets, research, and social development. How do you balance innovation, scalability, and impact when evaluating startups? What aspect of your diverse career has influenced your investment philosophy the most? Sorry.
Yeah, so I had nearly 2 decades of investment, or rather looking at public markets, right? Listed equities. So large companies which grow much more slowly but have their own ups and downs, and where you identify undervaluation, overvaluation of stocks. And so this might seem like a very different space, right? You're coming in so early to look at companies where there's very little on the board, right? But at the end of it, if you think about what really creates value, right, that comes back to first principles, that when the company is scaled, the drivers of value are the same, which is that the company should be highly profitable, has a good high return on capital, and has low risk in its business, right? And so again, Rajeev talked about 3 things, so maybe let me add 2 more, or rather let me sort of just leave kind of 5 things as a framework, right? And let me also give the caveat that it's not about identifying the future unicorn, but trying to identify. We'd all be very lucky if we could keep identifying it perfectly each time. But I would just say 5 things, and even if you're a startup, you just think of whether there are a large number of ticks on those. So the first is really on, are you a pioneer, or are you a disruptor, or are you an executor, right? And in all 3 models, it's possible to build an unicorn, but knowing very clearly whether you're the first in there and you're trying to ride a trend, or whether you're trying to do things very differently, or whether you're just saying, look, this is a business where the existing businesses don't operate efficiently and I will execute much better, is very important. So that's the first one. The second is what Rajeev just said in terms of size of the market. But the qualifier I would put there is that, is this a market opportunity that already exists? So a lot of companies or startups which are bringing in a digital angle to playing the same business already have a large market, but it's a different way of getting to it. Versus there are some new, you're still betting on a certain market and a very large market that will come in say 5 years' time, 7 years' time. So again, knowing where you are is important because the strategies you'll need to employ, how you might have to pivot will be very different. The third is really on the, some are driven by a tailwind, right? And what I mean by tailwind is there is usually a push. So let's think about EV and energy transition, right? We all know what are the factors. A lot of it is policy and other kind of push. Whereas there are some which are transformative trends. So think about whether it's wellness or pets. These are all things about consumer behavior and, which are changing very fast. And the fourth is really around the scalability and the value capture of your business, right? So there are a lot of businesses where you are onto something good, but based on a very small sub-segment or sub-market. But inherently, is there scalability, or will you hit a rough patch when you go to the next such local market? Something to know, and also value capture, right? I think a lot of tech-enabled businesses are great at getting to more customers, but are they really pulling much of value in that? Are they capturing much margins? So again, figure out whether you have the tick or not. And the last one is, of course, on the founder. And that's probably the most important one when you think about the marathon like you discussed, right? Because all of these we are hypothesizing as investors when we start. But finally, whether you will make that journey depends so much more on the founder. So what can we look at? We can only look at some attributes where we look at, what's founder ambition? What is their grounding in a sector, right? Sometimes if you're coming in absolutely blind, without even, you may not be from the sector, but have you done some groundwork of understanding how it works? And the third, of course, is leadership. So all of the things, some of the things, again, which Rajeev talked about, like, the team that you build. Are you recognizing that to get to that organization, you need to build a certain kind of organization? I think these are very important because things will always go wrong, right? And it is the attributes of the founder that will probably determine whether you get to that winning post or not. Thanks.
So I think we've established that it's not about identifying the next unicorn, but trying to, because it's so fluid at its early stages. Sherif, on that note, at that point where everything is fluid and dynamic, is there one factor that you lean into while making a decision? Mr. Rajeev has said TTT, so...
Actually, I gave a talk at FICCI here, not here, in Cochin about a year ago. And there I talked about 6 T's, not just 3 T's. Okay. And so those are the things that we really look at. And the first 3 were exactly the same that Rajeev said. Team, TAM, traction, right? The fourth thing that we look at is technology, which differentiates the company from others. I mean, what's the moat? What is it that will prevent others from catching up with you very fast? So do you have some IP? Do you have patented these things? Are those patents valuable enough to create enough differential? So that's the fourth thing that we look at. The fifth thing that we also look at is what we call a true fit. Okay. Now that's nothing to do with identifying a potential unicorn. In fact, first of all, we don't look for unicorns. We look for someone who can give us a 5x return in 5 years. Okay, that's all that we need. And So it can be that they sell at 100 million, we get our 5x and we are happy, right? But the true fit is where the company's goal and their values align with the fund's goals and values, right? And it's something where we believe we can add value. We can add value either in terms of opening up markets to them, we can add value in terms of their governance, we can add value in terms of giving them ideas or linking them up with our other portfolio companies and so on. So there are different ways in which the true fit can happen. And I don't recollect now what the 6:30 was, but anyway, so that's, so these are the things that we look for. And absolutely the most important thing is the team, and it's much more important than the total addressable market. And I'll give an example of Amazon, which started off as online selling of books. And what would have been the TAM for online selling of books? It would have been minuscule, right? But then they pivoted, they had a team which was good enough, and they moved into newer areas. And now books is a minuscule part of their total market and total value. So when we look at company, the first thing that we do is that we talk to not just the founders, we talk to all the CXO level employees, and we talk to one level below that. And only then do we really get convinced that we need to be investing in this company. We talk to their customers, we talk to their vendors. So it's mostly focused on the people rather than on all the other aspects of it. And it shows. We have evaluated more than 2,500 inputs that we have got for investment. I mean, requests we got for investment. We invested in 12. Now 13. I mean, recent this thing, but that's...
Definitely. I think it's, as the saying goes, bet on the jockey, not the horse, especially in the early stages. But has there been circumstances or instances where your approach has shifted based on the startup circumstances at any point?
See, we have never had a problem with the founders because we spend so much time in vetting that. The market conditions can change. I mean, COVID straight away killed one of our companies, which was into, franchise seed training on robots and IoT and things like that. They had to close all their franchise outlets because of COVID, and that company had to close down. So there are external factors which cause it. There has been one instance of, the founders fighting with each other and separating, which has been quite painful even for us. But that's all part of the game. So.
Thank you. Rajeev, you've been a founder yourself, so you've experienced the challenges of building something from scratch. What traits or qualities in the founding team give you confidence on their capability?
I think sitting in Kerala, I'm going to use the coconut tree again, right? So, look, I mean, as a founder, right, amongst the most poignant moments is when you don't know whether you can make the money to pay the salaries for the next month. You live a very tough life. Making business happen in any part of the world is difficult. In India, it's doubly difficult because everybody's out to get you, right? So, how many of your founders out here? Show of hands, please. So, power to you guys, right? You've taken the path less traveled. Power to you, best of luck, right? So, absolutely, right? So, it's not very easy, right? So, given that, the most important thing that you need to have is resiliency. That's what a nariyal coconut tree resembles, right? The wind can flow anywhere, but it's going to bend with it if you're really hard and strong. I'm sure that example is something that I think resonates. So that I think would be the biggest thing that one needs to have in terms of what needs to be there.
Resilience, you're saying, the ability to adapt to the changing terrain, right?
It's called pivots, right? How many of you understand pivots, right? This is the Angrezi term for it, right? Those who nariyal paid karta hai, that's what we do in English called pivots. That's what it's called.
Archana, is there a particular moment or behavior during a discussion or a pitch that made you feel a founder is truly exceptional, like in your many years of being in this space?
Yeah, I mean, there has been multiple times when I feel like, sometimes I lose it, like what the founder is saying, right? I just listen to the way he's saying and get many times mesmerized also. So, and those moment comes from the deeper insights, right? So if somebody is really has identified one problem to solve and build a company around that, then he has understanding of the whole ecosystem, where the things can go wrong, where it can go right. If the things are going wrong, what is the plan B, right? So he has, I mean, really like the founder who has done the homework and also developed some kind of wisdom on top of that. And if I see that, then definitely I invest in that company. And the second thing is, I always look for something in that founder, whether he's a hustler or not. And the third thing is, which I look for the ethics. Because first two can be there and ethics is missing, although it's very hard to judge in first couple of calls. But I keep looking for those signs, whether he's ethical or the kind of narratives he's pegging to me, whether from where it comes from which value system. So these are the three things which I continuously keep on looking. And I mean, many times I take the decision to invest before the call ends. So that way, good, bad, ugly, but it's an early stage investment. I do nothing much I can do before that.
That's true, and that leads me to my next question to you. Given your expertise in financial markets and research, you're so used to hard data, which I was talking to you earlier at lunch. How has your approach evolved when assessing early stage startups where data is almost, it's not there? So how does that?
Yeah, so you try and convert that, right? So I mean, if you work backward, right, you're thinking about a large company and you know that's a valuable company because it has got certain key strengths, whether it is a brand, whether it is sitting on a network effect, or whether it is just, a certain leverage of power over its other stakeholders, right? And what you have to do at a very early stage is you're basically trying to work backwards and say that, look, what does this company have, or what is there in this idea and this business model which can make it like that in 5 years or 10 years, right? And so that's what you're trying to judge. Is it a business model that has a huge amount of scalability? Are they really poking something which is not being addressed by the existing ecosystem? So I think that's what, you're mentally rewiring yourself to say, okay, can I think about looking at these? Can I fill in the dots, right? And again, I'd come back to the founder there, because that's the final judgment where if I think about, one of our companies, which is hopefully going towards a unicorn fairly soon. And I think it's a combination of a big vision. You definitely, and I don't mean just what you spew, but a vision based on what you know. I mean, you have done your homework, as Archana said, so you have a sense of what is the opportunity and also a ground level understanding, right? And this guy had actually worked in that sector for a couple of years. So what happens is that then, 2 years down the line, when you realize that the manner in which you started is not going to lead you there, you're constantly thinking, look, that vision is still there, right? You're not giving up and saying, okay, it's not done, but you're very quickly moving towards, okay, this is the other model that could get me to that larger opportunity. So I think that's the combination. We think about, look, where can this business go? And then you make the softer evaluation whether the founder has that combination of both the ambition and the grounding, firm grounding in the opportunity.
So you wouldn't say it's intuition guiding you. There is something more than intuition here.
Yeah, I mean, finally you have to take, that decision has to come from here, right? But yes, you can only try and get as much of comfort through these factors.
But Rajeev, what about like sectors with less predictable trajectories, like gaming or media? What do you do there? Is it intuition playing your decisions behind your decisions?
I think the one thing that I think every one of us has agreed on completely is that the team really matters, right? So
100%.
generally, so this is a personal anecdote. This is the way I react, right? So there is a fundamental difference when you're picking a startup and a founder, and when you're picking anything else, like an employee, right? So the startup founder is like a tiger, right? So he is going to hunt in a jungle, right? So, and the tiger cannot be trammeled. You can't put rules around the tiger and say these are the ways you do it. Whereas if you're hiring for an employee, you're looking for a powerful horse, right? You sort of give them training, they need to go in a particular direction, they have to pull along with the weight, right? So that I think is the argument I would make. When you're talking to a tiger, you expect three things. You expect arrogance, you expect them to turn around and say, Raji, you're bullshitting. At some point in time, the moment you say you're bullshitting to me, and you've actually convinced me why I'm that way. I mean, I know less than you. That's when the tick happens for me. Then I know that I'm going to invest in you because you know more about this than I do. That I think is an important trick in this because you're a tiger. You need to figure that out, right? So I think that it's not very describable, but when you get there, I think she said it very well when she said you get to by the end of the meeting, you sort of know whether you're there or not. It actually happens, and that indescribable, yeah, isme hai dum, that happens in that, right? So that is what you're looking for.
Right. So I think, like he said, in agreement, a lot of it falls on the founder's ability to adapt, their resilient nature. You have
Just
something
like to
say?
add something
Yes,
to
please.
that. As far as when we look at these things, we use a lot of objective data to eliminate. Right? So from 2,500, we'll bring it down to about 50, let us say. But which 12, 13 to pick up from that 50? Ultimately, it's that, do you feel great or comfortable with this person? It's ultimately a gut feel. But you can eliminate, 2,400 of those just based on, data and other things.
Right. So I think it's very important for founders to do their homework and not come into a conversation expecting the investors to do half the work there. A little bit about the market. Archana, are there any specific sectors or trends that you believe hold more promise than the others today? How do you identify these emerging opportunities?
So first of all, I want to mention that startup sectors, it's like changing session. The weather comes and goes. Sometimes hyperlocal is active, sometimes EV is active, sometimes e-commerce is active. So it comes in waves. And and it also changes as the weather changes, suddenly from summer to winter. But right now, personally, I'm focusing more on the EV space. I have a very large portfolio, like Log9, Alt Mobility, Zeb Electric, many more. And I think, as the EV is going to grow, more utility, people will start using more and more. The whole value system and ecosystem will develop, and multiple more companies will come to serve that in a various shapes and sizes. The second thing which I see is the semicon, and I'm very, very bullish about it. It's life coming full circle. It started first the semicon thing, and most of the friends, most of the people I know, they're far older than me who are working in the semicon industry and doing well in their 80s and early 90s. Now I see in India that boom is coming again in a various, the whole value chain, either from fabless, software supporting that, maybe manufacturing. So that is another area which I see it to be very, I am personally very bullish about.
Interesting. Krishnan, how do you differentiate between a fleeting trend and a lasting market opportunity? As she was saying, it comes in waves, and sometimes we're not really 100% sure.
Yeah, see, I think our investment, the nature of our funds and the investment horizons are pretty long, right? So the funds may have 8 to 10 years cycles, which means your investment horizon is 5 to 7 years. So you are anyway betting. I mean, if it's a 2-year wave, you may get in and feel good about them raising a round at a higher valuation within 18 months or 12 months, right? But that may just flop soon down the line. So I think as a fund, we've generally thought about, how do you look at new opportunities in underinvested areas, right? So we were one of the first investors to come into agri-tech, in the almost 10 years back when no VC would look at that space. Today, now a lot of the focus of our current fund is on deep science tech, right? So where we're basically saying, look, we see a revival in entrepreneurial energy and innovation coming out of science-based R&D from India, right? There's more of the ecosystem that needs to develop, but we're willing to take that early bet. So there are a few areas within that. I mean, one of them, Archana talked about electronics, semicon, which we're looking at. But areas where we've already invested, we're doubling down areas like synthetic biology, right? Globally, you're already seeing that wave of investment moving up over there, right? And we think that is just the beginning. Similarly, alternate materials, and that can go into all kinds of different use cases. So, and things like medical devices and, biotech from both health as well as ag perspective. So I think there's a few areas where I feel that, we are taking those early bets. If they're waves, they should be much longer waves, or else they will just not take off at all, right? That's the way we are betting on it.
Sherif, do you see similar opportunities in your area of focus? Healthcare and AI, that is.
So when we look at potential companies to invest in, we want to see if they're solving fundamental problems. We try and avoid the waves. We say, it may be a wave today, but when we want to exit, it may be, a trough, in which case we have lost most of our investment there. So you have to get in at a trough and, get out at the peak of the wave, which is going to be very difficult. It's pure luck, almost. So we look at things which are solving basic problems and which will continue to be problems. So one of the companies that we have invested is using AI and ML to look at the tissue cultures for cancer patients and then try to identify what is the right treatment for this particular patient. So they collect the clinical data of patients over a period of time and match it with the mutations that's happened on the cell and see if this thing. Now we believe that cancer is going to keep continuing. And that's not something which is going to reduce. And hence there will always be a need for such a solution. So whether it's the fad of the season or not, they'll still be making more money, they'll still be growing, and hence we invest in that. Similarly, to look at our other health tech investment, that's into saving preterm babies. And premature births are going to happen, and it's going to this thing, and their device actually helps babies in the most remote areas survive. Now, sometimes luck also plays a big chance. I mean, we thought that this was a great solution for underdeveloped countries and rural areas and so on. And these people they've got lots of awards, and one of the awards was in the US, they were given this thing. And the doctor said, we would like to take this device for our hospital. And these people were surprised. I mean, why do you need it? I mean, you have NICUs in every hospital. So they had an issue where this device was doing multiple things at one time, and every time you take a device out of an ICU and bring it back in, it's a huge process, making sure it is sanitized, making sure it is, no germs are there, and so on. Whereas if you can keep the device inside and use it for multiple purposes, then that much of work is avoided. So this was a total surprise for them. But anyway, but the basic premise that we went in with is that this is a solution which is going to be needed. Irrespective of the market whims and fancies, these are human these things, and hence it's going to always survive.
Right. Rajeev, you talked about the 3 T's that you had mentioned earlier. Can you give us an example of a company that maybe taught you a key lesson while evaluating a startup?
Where the 3 T's worked well,
Yeah.
which became a unicorn.
Not a unicorn.
Yeah, so I think one of my investee companies, you mentioned gaming, and that was one of the spaces that we were looking at. So this was obviously early days. Gaming was not really, taking off and all that stuff. That was the time that we looked at this team, and they were doing something very interesting because for them, the entire industry, these kinds of things revolve around certain key pivot points. One pivot point is the cost of customer acquisition. How much does it cost for you to bring the bacon home, so to speak? And a lot of businesses trying to blow a lot of money in Meta and Google and Facebook around that. And these guys were doing something with influencers a very early time. This is before the world caught on to the fact that influencers are a cheaper source of getting revenues, right? And they were doing some very interesting things with technology to try and make sure that the probability of winning was very high for those people that were there, right? So I think those two things were very, very edgy. And they had some very exciting things going on, right? But the thing is, once they came on board, then the question becomes, obviously, this is a very hot sector, it grows like crazy, right? And then the government start to look at it and say, hey, what is this? How does this work, right? And a couple of state governments actually in the south, Telangana and Tamil Nadu, started to go after them. Right? That's when basically, you needed to come in and sort of help them in some form or fashion, right? So that's when regulatory and other things started to become important, and we had to bring in some further help and support. That's where we helped them in terms of getting them to, actually we got Reliance to come on board at that point in time, right? And that helped them sort of, overcome that regulatory hurdle and get ahead in terms of where they were going. That I think would be a good example of this. But the important part about this example really is there are lots of things that can go right. There are lots of things that can go wrong. Just like he said, the NICU, America is full of NICUs, and healthcare is amongst the most over-invested spaces, and still his product was able to find a fit very simply because there was a very specific use case there that the NICUs were not able to fulfill, right? Those are the things that you're looking for. And that resilience that you talk about in the founder, when you find it, you nail it, you run after it, get after it, that's when you get the thing going and you just grab the opportunity there. That's what differentiates you in terms of that scale growth that you're looking for.
Right. All these lessons that you mentioned, even during lunch that we had spoken about, the different ones that influence your approach to evaluating startups, Archana, do you feel that it influences it at every time, or does a startup require a fresh perspective every single time?
See, the fundamental 3 T's, 6 T's and all those always remains the same, right? But the sectoral thing, whether you are evaluating the EV or you are evaluating the semicon value chain companies, then at that point of time, your evaluation process, that is the only difference is in the evaluation process. All those things which we had discussed earlier, it has to be there. But when it comes to the vertical specific, then you need to understand that vertical and you have to figure out how the solution is going to fit into that value chain. And that is the thing which we evaluate when the companies comes from the individual sectors.
Okay, so I think we've been asked to wrap up. So I'm going to quickly ask a question to all of you all. If there's one critical takeaway for the audience today, what would that be from each of you?
Starting there.
Yeah, I think there's a very wide framework within which you can play to build a unicorn. And I think the main thing is that, you plunge into the journey and then remember that the resilience, things will go right, things will go wrong, but you just need to be in there and you need to also sort of recognize the reality and move. So I would say that it's really that there is a lot of, different ways to grab the opportunity, but ultimately you have to go through the journey and, stick with it.
And I will give the same message the same message in a different words to all the founders who are sitting here, that you should identify, where do you stand? If you are if the potential of the business which you are doing is only 50 crore, then you should not be expecting the $1 billion outcome out of that. So you have to be realistic about your business, and also about your ambition and ability to take the pain in building that company. So I would say you should know yourself a little bit more while building the company.
I would advise the founders not to go after the, the fad or whatever is the latest thing in the season, but do something which they are passionate about, and then look at what, using that passion, how can I maximize the addressable market of whatever solution or product that you're bringing out with. And then build a team of people who are brighter than you, around you, so that you can actually be agile and be able to, go after that market.
I think it's the most amazing thing and time to be in India at this point in time. There are lots of reasons for that. I think some of those came out in the last panel about how the current geopolitics is working very well. But just take these two stats. India's average age is 27, right? That means most of our consumption is ahead of us, right? That means these are the youngsters that are going to now get married, they're going to have new homes, they're going to consume things, they're going to buy cars, they're going to buy bikes, they're going to buy, white goods, brown goods, green goods, they're going to invest. So most of our consumption as a nation is ahead of us. Similarly, most nations, when they go progressive, and when they go towards prosperity, they urbanize. At this point in time, India's got 52 cities with about 1 million population, right? That number in China is 300 cities, right? So we are going to get there. These two trends alone is going to mean that anything you do in this country, anything literally, is going to be gold as a business. I think that's the most important thing that I would say. So, I'm sure some of you have seen Gully Boy. So there was this line, Apna time aayega. I think Apna time aa gaya. That's my line.
Thank you all for this very insightful discussion.